Ayala Corp was down last week while the BSP signaled more aggressive rate cuts for 2024. Is the BSP being too optimistic? Let's discuss. My name is Den Slim, and welcome to another episode of Monday Market Outlook. So the BSP is set to cut rates by 100 to 150 basis points this year, according to Monetary Board member Ben Jokno. But the timing will be data dependent and would mirror any moves that the Fed makes. No, so this is why we also need to track U.S. Fed decisions, as it does have a significant effect on the local markets. But I'm a bit curious as to how data dependent the BSP is going to be versus just mirroring Fed movement, because what Mr. Jokno is probably saying is that the data dependency here is primarily data from the Fed and not exactly economic data. But if we look at economic data, November employment numbers came in at 3.6%, which is the lowest since April of 2005. No, so a very strong labor market for the Philippines, but it's kind of expected, no, due to the seasonal surge for the holidays. Now, meanwhile, trade deficit widened to 4.69 billion as we saw exports decline while imports continue to rise. So what does this all mean? Now remember that the BSP is looking at these same data points. It doesn't seem to be the right time for me, no, to cut rates, no, because okay, we see employment 18-year lows, which means people have money to spend. No? We are importing more stuff amidst higher import costs. No? Let's take a look again at shipping costs. They continue to go up against the backdrop of the Houthi crisis. Of course, anything that affects the Middle East also affects oil prices. We already see oil bouncing off of this heavily defended zone at 67, 68, and look at how oil has started to break out of 74, no, but good thing it has retreated back to around 72, 74. Then we have the peso suddenly depreciating last week to a high of around 56.39 before pulling back to 55.93. We have high employment, rising shipping costs, potential for oil prices to go up, a depreciating peso. And if the BSP is going to be data driven, the current data, at least economic data, doesn't really support a rate cut anytime soon. So what exactly will the BSP prioritize? Data or Fed movement? Now let's assume that the Fed does cut rates by March, which I doubt, and we continue to get the same economic data reads. Are we still going to cut rates just because the Fed did? No. So but anyway, let's look at the PSEI charts. The market seems to have difficulty breaching 6,680 as we see almost three rejection weeks at this level. There seems to be strong selling pressure every time taps this zone. We did get our best scenario pullback last Wednesday when Mitsubishi decided to sell 100 million worth of AC shares, because note that AC is around 6% of the PSEI, and significant movements like this does tend to pull the markets down with it. Historically, we've seen Mitsubishi sell shares at significant discounts compared to the market price. So should we buy the dip on Ayala Corp? Now let's take a look at the chart of AC here. AC pulled back way below our 696 critical support, but it was able to manage a comeback in the last few days. At this point, it's still a strong stock, and we are still placing our bets on conglomerates this year. I do not think that the index can move without the conglomerates moving along with it. So what basically happened here is that 696 now becomes a resistance for Ayala Corp. And even if we turn on the moving averages here, right, we see the 20-day moving averages, which could potentially converge with 696. It could present some challenges for Ayala Corp. trying to breach 696. Also worth noting that Mitsubishi still has around 4% stake in Ayala Corp. And given that they've been selling Ayala Corp for the past few years, the assumption here is that they will most likely reduce their stake to zero. When will they sell the remaining 4%? In 5 months, in a year, in 2 years, right? So we don't know. And this potential for Mitsubishi to pull Ayala Corp prices down again may create some overhang on the stock. As you can see, investors may have started to rotate into SM, another conglomerate, which shows a better price action, no, compared to Ayala Corp. Now we see SM above the 20 EMA and the 50-day EMA and the 200 EMA about to form a golden cross, no? So could this be a good switch for us to consider? JFC breaking out of 260. Finally, after several attempts, we did mention that you try to break out of a certain level so many times you'll most likely break out one of these days. And JFC did break out convincingly at 265. So let's monitor if JFC is able to maintain itself above 260 in the next few weeks. So congratulations if you are able to enter JFC back in November when we flagged this level as a good time to enter. For the PSEI, could we be seeing another pullback to 6,550? Or do we consolidate along this demand zone at 6,650 to give the markets some time to digest the gains, especially in the last 2.5 months? No significant economic numbers this week, but we will start to see earnings season also in the Philippines. Bank earnings will report soon, and if we look at the banking stocks, BDO, BPI, Metrobank, they've all started to move significantly. BDO coming off of breaking out of a descending triangle, BPI breaking out of a flag formation, Metrobank also moving up aggressively towards its trend line resistance here. Would it be a good time for you to top slice if you weren't able to rotate out of the banking stocks before? Right? But so far, if we look at the charts, there's really no signs of reversal yet. So it might be too early to rotate. Same for the PSEI. Despite the rejection weeks here, we are still in an uptrend. And the big difference here is that after this breakout of 6,375 here, this strong breakout here, we have managed to maintain the PSEI above the 20 EMA consistently. Hopefully, we can see another good week for the PSEI, no? So on to the global markets. Let's start closer to home as we check out how we compare to our Asian neighbors in terms of valuation at 12.42 and a forward PE of 10.81. We are attractively priced, no? Not too expensive, but not too cheap either compared to most of our Asian neighbors whose markets have rallied, no? Especially Japan, no? So hopefully investors turn their heads and rotate into cheaper and fairly priced markets like the Philippines. Now, but for the US CPI numbers came out last Thursday hotter than expected, no? 0.3% against the zero point 0.2 expectation, pushing the annual rate to 3.4% versus the 3.2 estimate. Now, still the culprit here is shelter, energy, and food, no? Pushing inflation higher in December. But Friday's producer price index surprised to the downside, negative 0.1% versus the positive 0.1% expectation, but core PPI remained unchanged, no, versus the 0.2% forecast, no, which tempered the markets a bit as the S&P 500 continues to consolidate along the 4,800 zones. Let's look at the charts. 4,800 here remains to be a very strong resistance level for the S&P 500. The market wasn't able to build up on this rally last Monday, and we just hovered along this narrow band in the last 5 days. Nevertheless, last week marked another week of gains as we enter into earning season. We do have a convergence here, one, and then this is going down. No? So this may signal some weakness in the coming weeks. But with the shortened trading week for the US, as the market celebrates Martin Luther King Day, we could continue to consolidate along this narrow range as the market awaits earnings results, because that's what really moves the markets, no, earnings. No, as we can see here, market returns have mostly been driven by earnings, especially in the last 4 years. So it's going to be the key driver for market movement in the next few weeks. Now let's look at the implied volatility for this week's stocks. We have stocks that can move 8% either to the upside or to the downside, depending on their earnings results. The major banks have started to report last Friday with mixed results. JP Morgan, BlackRock, Citibank, Wells Fargo reported last Friday. Goldman Sachs and Morgan Stanley will report this Tuesday. And next week, the tech stocks will start reporting, as well as the semiconductor stocks. So will their guidance and future earnings support the election year trend? Because if you look at trends, no, following a 20-year gains, we can see the early dip in Q1 followed by a rally, a weakness in Q3, and another rally in Q4. Same as the market trend during election years. We see the same dip, a rally, a weakness in Q3, and then a surge in Q4. So if we put this in context with what's happening in 2024, this dip here, could this be a dip adjusting to the disconnect between the Fed and the bonds market? So remember that the bonds market is expecting a Fed rate cut by as early as March, right? And the Fed is insistent on rates being higher for longer. If the Fed doesn't cut rates by March, so the market may adjust accordingly to that. And thus, we may see a dip, because I think the bonds market right now is being too optimistic with a rate cut. And the usual weakness here in Q3 is really brought about by the uncertainty of who's going to win the US elections. So as we see here in November, we start to see a surge. And by this time, the US market usually knows who's going to be the president, and this puts the market back into gear. So we'll see, right? That's it for this week. Please like this video if you found the information useful. Subscribe to the channel for more updates. As usual, good luck on your trades. Please manage your risks accordingly. And I'll see you again next week.